Good morning. It's Friday the 24th. Sit down, buckle up. It's going to be a busy day. This is what's going on. Trump imposes new tariffs that look about the same as the old tariffs. We'll talk about that in a moment. The tech sell-off gets ugly, and it's continuing in the Asian session. And Brent crude is still above $100 a barrel, Anna.
Absolutely. Brent crude is still above $100, and that's where we start on our little market check at the top of the 7 o'clock hour this Friday morning. Good morning, everybody. Down by 0.4%, but still over 100. Where will it go over the weekend? We're up by 38% in the month of July, which is a substantial move. Things moving pretty fast there. Eurostoxx 50 futures, a heavy selling yesterday in the face of that higher oil price and the tech sell-off that Guy was referencing. But we did close out the European session at the low point of the US session. So at least from a European perspective, perhaps a little bit of catch-up waiting to be done, and we look for that at the start of trade today. S&P futures, though, pausing for breath, thinking about the tech sell-off that's been the worst day in a month for the S&P yesterday. Things looking flat as we look ahead right now. The countdown to the opening trade starts right now.
Morning, how you doing? 7:01 in London. Let's talk about the big stories that are out there this morning. We could start with oil, $100 a barrel. We could start with a massive tech sell-off that we've seen over the last 24 hours. But let's actually start with this tariff story. Tariffs are back. You've now got a new round of tariffs coming out of the Trump administration. These look much more permanent than the ones that went before them. They're based on Section 301. They're going to affect 60 economies. The rate ranges from kind of 10 to 12.5. It's pretty much the same as what came before, but there are some differences which are significant. They're based around an investigation around forced labour. We can park that one for now, get into it a little bit later on. But basically, here's the timeline. These are new permanent tariffs that are going to replace the temporary tariffs that replace the tariffs that were thrown out by the Supreme Court. But they look more robust from a legal point of view, and probably are quite sticky.
Absolutely. So I think that's the key word, isn't it? Are these stickier? Do they change the rates that some of the nations around the world are paying? Maybe not, because we've, as you said, we've had this temporary 10% in place. We've also had some interesting detail about how this rubs up against other deals. So this won't get in the way of the deal with the UK, the deal with the EU, Japan, South Korea. So all of those countries have their own deals in place already. So maybe these are sidelined as a result. They are more telegraphed. They've been telegraphed to the market, so it won't be a surprise. We talked about this last month, didn't we? And there are so many exceptions. So fuel, food, fertiliser, all exempt. Anything that's already got a sectoral approach to it. So autos, drugs, metals, all of those things are exempt. But it does remind us that we're not done with tariffs heading into the midterms. And actually, there's quite a lot of worry about another Section 301 investigation around excess capacity and whether that will result in some higher tariffs later on this year.
But they're not going away. They look sticky. They look like they're going to be here for a while. They're effectively permanent. And they're just another piece of evidence of grit in the machine of the global economy. It's further evidence of this deglobalization process. It's further evidence of supply chain issues and inflation, ultimately, that will, in aggregate, in the background, just accumulate in the global economy.
Yeah, absolutely. So this does have an inflation dynamic to it, doesn't it? Let's move on and think about where we are on energy markets and wider commodity markets, in fact, because it isn't just energy, it's other foodstuffs. So I was reading about wheat this morning, about wheat prices going higher on the geopolitics, port attacks as part of what we've seen happening in the Middle East and over in Ukraine and the extension of the activity outside of Ukraine. So up by 19% month to date on wheat prices, Guy, which is something we haven't even mentioned, and all of that sounds like inflation. But in terms of the oil story, we're above $100 a barrel. We're set for a weekly gain, up by 38% in the month of July. President Trump has been talking to Axios, talking about considering massive attacks. So are we going to witness in the short term a step up in violent activity in the Middle East, and what is that going to do to our ability to get things out of the Strait of Hormuz and also through the Red Sea, because that is now very much an area that we're watching?
Yes, and we're going into a weekend when traditionally actually the attacks have come more frequently. I think the real story actually is the oil story is interesting. The real story, I think, here is in the bond market and how the bond market is reacting, not just to the oil price, but this kind of expectation ahead of Washington, what the Fed is going to be signalling. US yields are just rocketing higher at the moment. The front end in particular, I think, is in focus, but you just got to look at what is happening with the US 10-year. We're at 4.71 now. There have been some big moves in the US bond markets over the last few days. And I think this is something that has yet to fully be onboarded by other areas of the market. Certainly equity markets, I think, are beginning to start to pay attention to. You've got a big move in credit at the moment, particularly with the hyperscalers. So I think there's really interesting things beginning to happen in the bond market that are partially related, partly wider related. Yes. And I think this is the kind of the building story that is happening right now.
It's interesting that some of our guests, when you ask them about geopolitics or you come at your markets questions with something to do with Iran, there's even now, there's still, when we're back above $100 a barrel, still a temptation to say this will be resolved. But the longer this lingers in bond markets, the harder it is to ignore. And that does seem to be something that comes through in our guest conversations. And on that theme, I know there are other dynamics in Japan where arguably the central bank is accused by certainly some of our guests of being behind the curve. 40-year yields rising 10 basis points to 4.01%, a red headline on the Bloomberg terminal, just reminding ourselves of the direction of travel for these global yields. And
let's talk about tech. Tech
does seem to be moving higher.
Absolutely. Tech got hammered yesterday. Mag 7 continues to be hammered. It's being hammered overnight in the Asian session as well. The Kospi is under significant pressure. There are exceptions. We're going to be talking to SAP in a few minutes' time. Its ADRs were up sharply overnight as a result of the numbers that it's just been posted. Intel is an obvious exception. Clearly, it is turning out to be a major beneficiary of the hyperscaler build-out story. An unexpected one in some ways. Maybe some expected it, maybe some didn't. But Intel has smashed through expectations. So there are idiosyncratic individual stories that I think are an exception here. But the sell-off is ugly over the last few days. We thought we had respite, but we clearly don't. SaaS stocks have been hammered. Anything to do with the hyperscalers are getting hammered. The chip stocks are a big beneficiaries. But the move is significant. And again, I come back to the bond market. I think we've got CoreWeave's, one of CoreWeave's bonds that I can show you, just as emblematic of what is happening here. Look at the big spike higher we're seeing on the right-hand side of the screen that we get with CoreWeave. You can see it here. And you can't see it on that chart.
That's the share price, I think.
That's the share price, I think. I need to put my glasses on, but you can see it when you get to the credit side of things. There's a big move in credit. The credit market's beginning to kind of have serious concerns about this AI build-out story.
Yes, I wonder what some of the later earnings stories like Intel. What does that mean for European stocks? You talked about SAP, and that is an area of brightness. It seems cloud sales doing better there, so we'll get to that. But that is expected to go higher at the start of trade. What is in it for Europe around the Intel story? So the Intel numbers coming in better than expected, it seems. Data center customers spending money there, and Bloomberg Intelligence making the link with ASML and saying if this is what Intel is doing and they're one of the companies that are prepared to spend on the more expensive kit over at ASML, it could be good for them. And could that put pressure on others who are more reticent, like TSMC, to spend more there as well? So we'll look, is that a silver lining for Europe just in the very in one short time period? But yeah, broadly, we are experiencing some big volatility when it comes to the tech story. And it won't end because we've got big US tech earnings next week, and we've got SK Hynix and Samsung reporting next week. So a lot still to learn about this AI capex build-out.
We're going to learn more in just a minute, because we're going to be speaking to Christian Klein. He's the SAP CEO. We'll get his take on what is happening here. Arno Antlitz has been talking to us as well, the Volkswagen CFO. Volkswagen posting some difficult numbers this morning. Market not liking what it's hearing. Christel, Rendu, the Lindt, Vontobel's co-CEO, joining us out of Switzerland. And Sebastian Redler's going to be here, Bank of America's European Equity Strategy Head. Let's talk about some of the other things that we're watching throughout the trading day. We are going to be getting Euro area PMIs. We get a couple of them during this programme, actually, but the Euro area as a whole, we get at 9 o'clock. The UK PMI story comes through at 9:30. 2:45 p.m. UK time, we get US flash PMI. So we're getting a sense of the toll, perhaps, that higher energy prices are taking. Or we're going to be back to that story after we maybe had seen a little bit of respite on that front. So that will be front and centre. Later on today, President Trump is set to attend the rescheduled White House Correspondents' Dinner. So we'll hope that goes off more peacefully this time around. PMIs are going to be interesting. What are they going to tell us about where we are with the economy? The current data, I think, are slightly weird in as much as I think they're going to tell us that there's been a kind of drop in the oil price, but then we've got to go back to a higher oil price. Anyway, we're going to talk about that next. That is coming up. We'll bring you those key readings. They are going to be a big feature of the landscape. Plus, we're going to look at stocks to watch. Volkswagen, the German automaker, indicated lower this morning after slashing its sales outlook. Up next, though, Anna Titarová is going to be here, European economist at UBS. We'll get her take on what the ECB had to say yesterday. Any questions? IB Plus BBTV Go is the function. BBTV Go. I'll say that slowly. This is Bloomberg. Where are we? 46 minutes to go until we get to the equity market opening trade. This is the picture here in Europe. As Anna pointed out a little bit earlier on, we've got we finished at the lows yesterday. We moved higher, so therefore we've got all of that to price in when it comes to the European equity story. But overnight, the tech sell-off has continued in Asia. We're less exposed to that, but nevertheless, it is a factor for Europe to factor in this morning.
Let's talk about where we are on the oil price then. The price of oil is holding above $100 a barrel. That's Brent, of course, after President Trump threatened to escalate strikes on Iran and hold the country responsible for any attacks by the Yemen-based Houthis on ships in the Red Sea. For more, let's bring in Ona Ant, Bloomberg's managing editor for the Middle East and North Africa. And Ona, good morning. Thanks for bringing us the update. Does it seem to you that the market is, at this point, fearing escalation rather than hoping for de-escalation? I mean, maybe both, but the emphasis on the former.
Probably so, and we have seen, just as of yesterday, the Iraqi Prime Minister did relay a truce proposal to Iranians from the US that was flatly rejected. That's according to the New York Times. Now, the paper doesn't say what exactly the contents of that proposal was, but the narrative coming out of Iran suggests that it was a short-term temporary truce under the 60-day original truce that has now all but collapsed. What this shows is that, yes, there are efforts underway to de-escalate the situation, the fighting, the flare-up in fighting that we have seen over the last 2 weeks. But the differences between the US and Iran, especially on the issue of Hormuz and who controls it and how, just remains far too wide to expect an imminent breakthrough in talks or in negotiations, which is probably why we're seeing what we're seeing in oil markets that you mentioned, Anna. Now, this is also part of the reason why we have seen Houthis in Yemen, the Iran-backed militant group, open a new front in this war, and the impact is quite visible from the oil markets, where Brent is already above $100 a barrel, and where it goes from here is very much going to depend on the involvement of the Houthis. We have seen that they have let at least 2 Chinese oil tankers carrying Saudi Arabian oil exit the Red Sea. So clearly, the blockade on Saudi Arabia is not really a blanket ban, but at best it's a selective blockade being imposed by the Houthis. And where the oil price will go from here will very much depend on how stringent they go about their so-called blockade of Saudi Arabia going forward, Anna.
And I'll pick it up. Thank you very much indeed, Anna Ant, on the oil market. 3 weeks ago, just over 3 weeks ago, Christine Lagarde was sounding a little dovish at Sintra at the Economic Forum, and that seems to have changed. Certainly that was the message yesterday. The widening conflict in the Middle East pushing energy prices higher. Christine Lagarde, therefore, says the central bank is still vigilant when it comes to inflation. Lagarde laying the groundwork for a possible hike in September yesterday after the central bank held rates steady.
The energy shock continues to feed into higher prices. It is becoming more expensive for firms to source inputs, and they therefore expect to put up their selling prices. While developments in underlying inflation have remained contained, the full effect of the energy shock have yet to play out.
Joining us now, Anna Tsurova, European economist over at UBS Asset Management. Good morning.
Good morning.
3 weeks ago, she was starting to sound dovish. Yesterday, she sounded hawkish again. When does the next rate hike come?
I mean, our baseline is that they do deliver one more hike in September. Obviously, the change in the language, the change in terms of the rhetoric around the balance of risks came on the back of a big spike in oil prices and also gas prices. So that was sort of expected that the ECB will sound more cautious. Also, just to remind you, when we look at inflation dynamics, what's been driving inflation higher so far was largely the direct impact of high energy prices, so higher fuel prices, high utility prices. The indirect effects are yet to play out, and that's what keeping ECB concerned.
So that would be 2 hikes, right?
Yes.
Okay. Is 2 a cycle? And what would it take? Do we need to see those second round effects to have a cycle, i.e. the 3rd hike, the 4th hike, potentially? Is that what now needs to happen for that to take place?
Our baseline has been for some time that they will deliver only 2 hikes. We never said that this is a new tightening cycle. We more viewed it as sort of risk management, also a bit of a security or insurance policy. In terms of second round effects, the view from the ECB is that if you start seeing second round effects in the data, it's too late. And that's why we thought that they will need to be preemptive and start hiking ahead of seeing any signs of second round effects in the data. It looks that so far, and that's something that President Lagarde mentioned yesterday, at the moment they're not seeing any signs of second round effects. That's also our baseline, that's given the backdrop, economic backdrop, labor market backdrop, risks of second round effects this time round are less pronounced. But if we see a change in the situation, potentially the ECB hearing something more concerning from the companies through their telephone survey, that could be the case then where we could see them potentially discussing doing more.
Okay, so good morning, Anna. So I was going to ask you how you get around the fact then. So if you wait for the data and you're too late, how does that fit with a data-dependent approach? But from what you're saying then, it's more about what they're hearing in the economy, what they're hearing from the businesses they talk to, that will dictate whether they're ready to hike or not necessarily waiting for the data then.
Exactly, yes. That's when it comes to second round effects. I mean, even before we get to second round effects, what also President Lagarde reiterated yesterday, what matters for them is duration and intensity of the energy shock as well. So if we, let's say by September meeting, we're at $100 per barrel for oil, as she mentioned yesterday, we're still sort of in their baseline. But if we start seeing oil prices moving higher from here, them getting more concerned about gas prices, then their assessment around the intensity of the energy shock might also change, and that could contribute to their reassessment of the inflation outlook as well.
Last time, we're waiting for the PMIs for the Eurozone today. Last time it came in around 50, and the expectation is it is around 50. This is the composite number. Is there a concern? I mean, that's bang on where you start to expand an economy or contract it, hovering in between the two. It's not an overwhelmingly convincing growth picture, I suppose. So is there a concern that these hikes have to be unwound pretty quickly next year? Is that your concern?
I mean, I would just quickly start by saying when we look at the incoming data, we actually see a gap opening up between what the PMIs or soft data survey data is telling us versus what we see in terms of hard data. So things like industrial production or retail sales, where survey data, in particular PMIs, were signaling either slowdown or even signs of contraction in the second quarter, whilst when we look at the hard data, we see that the economies are doing actually relatively well. Having said that, because we don't think that the ECB necessarily needs to do sort of a whole tightening cycle, our view has been that at some point they will start unwinding these interest rate hikes. And in our baseline, we see them starting to cut rates in Q4 next year, and then essentially going back to 2% by Q1 2028.
When are the wage rounds? When do the big wage rounds start to come in?
So it depends on the country, but usually the bulk of that across the region is in Q1.
So we're going to know at the beginning of next year whether or not we're going to see second round effects.
Essentially, we should start, that's when the bulk of the information is going to come in. We already, for example, in Germany, where wage negotiations are staggered, we could see potentially first signs coming in a bit earlier. This is not our expectation, but essentially second half of this year, and most importantly, Q1 next year.
Start asking CEOs whether or not they're going to be raising wages and what kind of rate they're going to be raising them to.
Anna, can I ask about the Bank of England? Because you seem to expect, like lots of people do, that we won't get a hike from the BOE, but they will, like the ECB then, in your expectation, next year, cut rates. Does that make sense when you stand back and look at where inflation is in the UK, how long it's been above target, and how the ECB successfully managed to get inflation down to target, didn't they? But then, of course, it spiked up again afterwards. So does it make sense that the Bank of England is not hiking when the ECB is?
I think we need to look at a difference in starting points for the UK economy versus the Eurozone, and the two things that differ. First is the state of the labour market, the fact that in the UK it has weakened substantially. Now the latest data suggests some stabilisation, but still
can we really know about the labour market? The data is often... one of our colleagues sat down the other day, we tried to ask him about the labour data, and he just sort of shrugged and said, I mean, does it tell us anything anymore?
I mean, that's a very valid question. question. There are big concerns about the quality of the data. But I think when you look at the bulk of the information from various surveys, or so the labor force survey, it does suggest that the labor market has substantially weakened. But I would even say that even what matters even more is the starting point for the Bank of England. The fact that at 375, I think majority of the MPC members would still agree that we are in restrictive territory, whereas the ECB managed to get policy rate to 2%, which is closer to neutral. So the starting point is for the Bank of England that we're still in mildly restrictive territory. So from our perspective, the view has been that in order to address risks of second round effects, it would be sufficient for them to keep rates in current restrictive territory for longer.
European bond markets are just beginning to open up. Germany yields down, France yields down a little bit, actually a little bit more. US yields are up, though. US yields are up a lot recently. 10 years at 4.7, front end's moving pretty aggressively as well. How much of that spills over into Europe?
The spillovers are quite significant, especially when it comes to the UK markets. And obviously for the Eurozone that matters as well. Of course, oil has, and the whole the trajectory of the conflict has played a role as well. But US spillovers are very substantial. And of course, markets thinking about the strength of the US economy matters for Eurozone yields as well.
Okay, Anna, thanks so much. Thanks for joining us. Anna Tisareva, European economist at UBS Asset Management.
OK, let's talk about what else we need to know this Friday morning. SpaceX has postponed the next test flights of its Starship rocket until later today because of unfavourable weather. The launch will mark Starship's first test since SpaceX's IPO, following an aborted attempt last week. Meanwhile, Bloomberg has been told by the company that it has started to turn away satellite operators seeking launches using its staple Falcon 9 rocket beyond 2028. The move underscores the bet that Elon Musk is making on the unproven Starship. Volkswagen has cut its revenue expectations for the year as falling sales in China intensify pressure on CEO Oliver Blume to overhaul Europe's largest car maker. The German manufacturer now sees revenue declining as much as 3% this year. The results underscore the scale of the challenge for Blum, who is trying to make Volkswagen faster and leaner after years of software delays, bloated costs and declining profitability. And the UK Prime Minister Andy Burnham will open a new branch of 10 Downing Street in the northwest today, northwest England, in an attempt to demonstrate his vision for devolving power away from London. Named number 10 of the North, the office will be based in Heron House, Manchester, which is currently used out of interest by spies in Britain's Signals Intelligence Agency, which is GCHQ. Burnham, who became Premier on Monday, is expected to work there at least one day a week.
There we go. The new working from home, or not quite, depending where you live.
Nearer to home.
Yeah, working nearer to home. Interesting on the data front in the UK, we actually got retail sales data out this morning that beats forecasts. And no surprise, drum roll, what were people buying last month? Outdoor products, clothing and air conditioning.
Yes.
That doesn't surprise anybody, does it?
No. All the things that you basically need to deal with the oppressive heats that I'm really hoping is going to end soon. Anyway, what are we going to talk about next? SAP's cloud revenue comes in just ahead of estimates. We are about to speak to the company's CEO, Christian Klein. We'll get his take on all of this and the latest on the SaaS story and what it all means for his business. We'll do that next. This is Bloomberg. 30 minutes ago until we start equity trading here in Europe. I have good news and bad news. The bad news is that there's been a really big sell-off in Asia overnight in the tech space. I have good news in the form of actually Europe looking okay. We're fairly flat at the moment. Nasdaq mini futures are down by 0.3%. So actually a fairly benign, neutral picture, I think, going into the equity market open. Single stock volatility, though, I think could once again be a big feature of the landscape here in Europe once again. Absolutely.
We'll be on to that in just a moment with some earnings stories. Let's quickly detour via the bond market and take a look at what is happening there. As Guy's been saying this morning, the big story this week seems to have been higher yields, certainly in the US on the the rethinking of the Fed's trajectory story. That seems to be dominating. Here in Europe, also responding in bond markets to higher oil prices. But did we do a lot of that yesterday? Certainly that did move yields higher in yesterday's session. And it looks as if we are just pausing this morning and things moving a little. Well, we're seeing some buying, actually, at the European 10-year, and some of those yields coming down a little bit, but not by a huge amount. Let us talk about some of those corporate earnings then. As mentioned, SAP's cloud revenue grew at a faster pace than analysts expected as customers move away from on-premise licenses. Europe's largest software company is facing threats to its business from AI, well documented, of course, as it pushes clients to migrate accounts from locally installed programs to new products in the cloud. SAP's ADRs, their American depository receipts, jumped following the results, and it looks as if we are expecting to see the stock pop a little higher at the start of trade this morning. Christian Klein joins us, CEO of SAP. Christian, very nice to have you with us. Lots to discuss. So the good news in your numbers, cloud revenue better than expected. Your customers then migrating to the cloud. That continues to be a trend. What does that tell us about the underlying strengths of the business at this point, Christian?
Yeah, good morning, Anna. Yeah, I mean, we are very, very happy with our quarter. I mean, we have even seen an accelerated cloud growth compared to Q1, far ahead of the market, of our competitors. And even in the cloud, 90% of the deals also had AI included. Yeah, so which shows that first, the ERP is absolutely needed, as this is the brain of every company, and then the agents are built on top, and that gives us a lot of confidence with such a strong half year one, especially in such a volatile market environment.
Okay, so the migration to the cloud continues, Christian, but in amongst all of that, we add on, and you've suggested this includes AI, but we add on the concerns around AI. SAP's share price down by some 38% year to date because of concerns about the so-called SaaSpocalypse, what AI will do to companies such as yours. Do you have a much better understanding now of where the vulnerabilities lie for SAP?
Yeah, absolutely, Anna. I mean, first of all, it's great to see that also our customers are now turning towards SAP as they understand that the LLMs, they don't understand business process. They don't understand business data, and also they don't understand governance. I mean, you cannot just have agents doing your financial close, not adhering to the governance of a company. So, and that is all sitting in our ERP. And with the launch of the autonomous enterprise, our customers have seen that SAP can deliver accurate and also compliant AI. And that, of course, also is reflected now in our Q2 numbers, and also gives us a lot of confidence for the second half, where the pipeline actually looks pretty strong.
Christian, can I just pick up on that? Good morning, it's Guy. OpenAI is making waves again in this space this week with its new presence model, which is causing not your direct competitors, but people in the SaaS space to see their share prices come under significant pressure. Now, in some ways, you could argue this software doesn't directly affect you. But in some ways, you could argue further down the road, it might. You've got your Joule software. It sits at the integration kind of layer, the orchestration layer, which is quite a valuable space to occupy. And it's looking to target that kind of space. And I'm just wondering how worried you are, to Anna's point about kind of understanding the risks, about how big the risk could be of OpenAI coming in and controlling that kind of integration layer, that key interaction layer that we're dealing with here. And I'm just wondering whether or not that is a threat that is emerging, a new threat that you see emerging right now.
Yeah, I mean, absolutely, Guy. I mean, AI is a disruption to the software industry, without any doubt. But look at SAP. I mean, we are running the world's most mission-critical business processes, complex processes. And there is a lot of domain logic sitting in the ERP. And when you now look at our AI platform, you can choose any LLM you want. And by the way, not every frontier model is the best for every agent. You can also use open source models where you have a much better price to outcome. But then what you find on the SAP AI platform, on the business AI platform, is also the context layer. So we are building our own AI foundation, where we are building the ontology with our business data, with our business processes. Because again, the LLMs don't understand, are not trained on this logic. And when the two worlds are coming together, this is of course how SAP can really deliver accurate and also very compliant AI.
Yeah. But is there going to be a fight over that interaction layer? where the two systems integrate? Is there going to be a fight there? Do you need to make sure that you control that point?
I mean, we always said, the customer's data is the customer's data. And we have an open platform. We also include third-party agents. There's no problem about that. We are believing in the value of our platform because, again, this business context is only available on the SAP Business AI platform. And that's why we believe in the value of the platform. We don't want to lock in customers on our platform. We want to have an open platform. We have APIs. We have MCP servers. We want to actually run business processes end-to-end with our autonomous agents. And that's why we believe in the value. And there is definitely not a fight about, locking customers into our platform.
I wonder, Christian, how concerned you are about costs and how much you're having to spend at this point to innovate and to keep up. I started this conversation talking about how revenues came in above expectation. Morgan Stanley suggesting that maybe the R&D costs were higher than they had anticipated. Are you concerned about how much you're having to spend to keep up in this race?
Definitely in the R&D costs, you see, a higher token consumption as we are using AI to code additional features, but especially now additional agents. But vice versa, you also see a huge productivity increase of 30%. So the last 12 months was really about ramping up our R&D workforce, bringing in some top talents, especially on the data scientist side. But now, from now on, it's really about gaining the productivity also by applying AI in our R&D workforce.
Yeah, and Christian, on that point then, so you mentioned there the increased token costs, but then the increased productivity. So what is the return on your investments in AI?
The good piece is, Anna, that we can switch models on our AI platform. Again, we are not only using the frontier models, we are always using the best model, which actually provides the best price to outcome ratio. So that, first of all, makes sure that we have healthy cross margins going forward, both for our external customer business, but also applying AI internally at SAP. Second, obviously, we are also managing tokens as part of our cost budget. Yeah, you have a headcount budget, you have third-party budget, and you have tokens. So our managers in R&D, in the go-to-market space, they have one budget and they have to manage that also according to the productivity assumptions we reflected in the budget.
Christian, just kind of picking up on all of this, do you get the feeling now that we are moving into a different phase? That who's ultimately going to win this battle? Do you think it's going to be frontier models? Do you think it's going to be the open source models? Cost is becoming, and you are one of many CEOs that we talk to about this, and you're all giving the same answer. We are now managing our token budget. It is a cost we have to manage. Do you think that ultimately points us in the direction of open source models?
Guy, there is not one winner in the tech space. Again, these LLMs, they will become now more and more commoditized. They are super strong, but there are a lot of new open source models entering the market. But now I feel that the value creation, moves up from the infrastructure, from the chip side, into the application, into the agentic AI layer. And so you need both worlds. But I feel now companies like SAP will benefit now from the advancements, technological, on the infrastructure side, on the chip side, by building now this agentic AI layer for our customers. So there will be not one winner, but there is also definitely not an LLM provider taking the whole market, especially not in the ERP market.
Christian, at the end of June, you announced another top-level reorganization at the business, which, as a result of which, you've got a bit closer to managing some of the AI challenges that the business and opportunities the business has. So your chief product officer, you've got some of his job. Is that sustainable as the CEO? And what kind of insight has that given you?
Anna, first of all, yes, indeed. Muhammad Alam is leaving SAP, he's still around, but he's leaving SAP for personal reasons. So I took over his responsibilities. We are in the transitioning period. I guess in this time right now, having the oversight about our development organization is actually a good thing, because you have to see we are moving from coding features for software into coding agents. So we have to change the operating model, the way how people work. We need to apply AI in all of these jobs. So it's good to be close to development these days, but over the next months and quarters, we will definitely also find a successor so that I can solely focus then on my CEO role.
Okay, too many hats. Christian, great to catch up. Looks like the stock is called higher this morning, and we'll look to see it open in around 19 minutes' time. Thank you very much indeed for your time once again. Christian Klein, the CEO of SAP. And we've been talking to a lot of tech bosses and bosses broadly across a range of industries about what they're doing in terms of their CapEx story and what concerns them.
If we think that the CapEx headwinds are going to continue, but 80% is already growing at about 8%. We want to put a lot more focus, so we're going to direct a lot of the team with forward deployed engineers, with people who are focused on deploying the software at clients, much more technical help, and make that 80% grow even faster.
IBM's chair and CEO speaking to Bloomberg. We're going to have more on the setup into the market story, what that CapEx narrative is going to mean. We'll do that a little bit later on as well as we talk to a series of CEOs. Volkswagen CEO, CFO is coming up. 80 minutes to the open. This is Bloomberg.
Certainly can go higher from here, right? We've already seen higher prices. Yes, we have some mitigating factors, but at the start of the week, we knew that Hormuz shipping was essentially shut down. You had threats to oil infrastructure. That's very bad. And then on top of that, you have an additional threat to a choke point this week. If you're thinking about physical supply right now, where oil demand is relatively inelastic at the front, if you have more disruptions, you could see a rapidly higher price there if you're no longer able to go through that strait.
Super resilient market. And while we always see perturbations here or there, regional perturbations, which we're seeing now, this isn't a market that moves quickly because you have to make orders for aircraft well in advance. And we think that the demand is set for our aircraft going forward.
World has changed. There are many threats. We have to provide our customers and governments with new means of facing those threats. And this means accelerating in new developments, accelerating in new technologies, and accelerating in delivery of what we have already in our hands.
Europe and China and Japan and Korea all need to build their storage of natural gas ahead of the winter. So I think we're going to have to face some competition for cargoes.
Gas is the input of a lot of chemical processes. Europe's going to have high energy prices for the foreseeable future. You have a supply environment in Europe which is going to be challenged for years to come.
Years to come. Just a few of the guests on the show that have been speaking to us this week discussing the impact of the potential escalation of the conflict in the Middle East. And let's start our next conversation there. Let's talk about the markets in 3 minutes with Adam Linton from the Markets Live team here on the opening trade. Adam, good morning to you. So the oil price, it retreats 1%, but that doesn't really matter, does it? Because we went back over $100 a barrel, up by some 38% in the month of July alone. Not $120 short, but back over 100. I was reading on the Markets Live blog yesterday, one of our colleagues talking about a focus on the Yanbu export terminal in Saudi Arabia, that's going to be the area to watch. What are you watching when it comes to energy prices and the hold that this narrative has over other assets?
Yeah, in terms of where we go from here in oil, it's an element of a guessing game. You've got to map the reaction function of President Trump against Iran, against Israel. But in terms of the tenor of news flow, I think, directionally, risks obviously tilted to the upside. And I think as my colleague Michael Bull put it yesterday, for risk assets, it means that macro is now back in charge with Brent above $100 per barrel. I think futures, they've been holding it up relatively well today, but, let's see what happens. Do we kind of see a return to this conflict trading pattern whereby risk gets pared down into the weekend? That's what I'm looking out for. And I think also, during the conflict, we saw tech act as an offset for some of the energy angst. But clearly now that's not happening. Alphabet, that was a disappointment this week. We've got more hyperscalers due on deck. Intel, they reported yesterday, and they've not really had a material impact on the market, even though their earnings are pretty solid. Then overnight, we saw some softness in some of the Asian chip stocks, on which we've got Samsung and SK Hynix releasing earnings next week into an index which basically trades vol on an 80 handle. So it does look like risks are potentially tilted to the downside for stocks.
Oil got Christine Lagarde to sound hawkish again yesterday. Is it going to get Mr. Walsh to sound hawkish as well next week? This is the question that everybody's... how big an impact is this going to have? The bond market is moving aggressively at the moment to start pricing in rate hikes for the Fed. When do we actually see that translating into reality?
Yeah, I mean, this is the absolute big debate in the Markets Live IB chat yesterday. There's a lot of factions on here, but clearly the decision is a lot more finely balanced than it was a few weeks ago. I think the key for the market now is ultimately the Fed have reaffirmed their commitment to inflation fighting, and now there's an increased expectation they could potentially move next week. I think the problem for the market is we're in the Fed regime where forward guidance has been pared back dramatically, and that's what the market's really contending with. Next week's going to be a lot more of a high vol event than it potentially would have been, owing to higher energy prices and the unknown reaction function that we have at the Fed.
We're going to get PMI data out of Europe today, Adam. It hasn't broken yet, but when it breaks, are we going to have to think of it as too backward-looking, given the big ramp-up in oil prices that we've seen just in the last week or so?
Yeah, that's pretty much my take. I mean, yes, it will cover, some of the fallout from the breakdown of the MOU, but it's just such a fast market at the moment that any piece of data that gets released feels relatively stale. None of it's going to capture the ramp up that we've seen in Brent. Potentially the final releases will later in the month, but ultimately it's such a fast market. We're monitoring what we're hearing from central bank officials. And in terms of what we heard yesterday, from officials in Frankfurt, it merely just validated what we're already expecting. The ECB, they're going to probably move in September. What happens beyond that, is anyone's guess. But in terms of central banks as well, things pick up next week. We've got the BOJ, that could be the FX story of the week next week. Do we potentially see a move towards 165? And do the BOE stay dovish?
Lots of questions. We'll get some answers. Adam, thank you very much indeed. Adam Linton joining us from the MLIV team. MLIV Go, of course, on your Bloomberg to find that great chat, ongoing chat. OK, let's talk about some single stocks and figure out exactly what is happening this morning. Chloe's here with the details.
Good morning, guys. Let's start with SAP because the cloud revenue came in stronger than expected last night. And so this is something that could potentially reassure investors after there has been so much worries among those shareholders about the impact of AI on SAP's business. And so we have seen a huge pressure on the shares so far this year. We are down almost 40%. So this encouraging update could be something that helps lift this. And then it's also worth noting that Bloomberg Intelligence analyst said that the cloud backlog outlook for the full year actually looks quite conservative as well, which means that there could be room for upgrades. So potentially a positive update lifting the shares this morning for SAP. Moving on to Volkswagen, and it's not as positive of a story. We've got Volkswagen cutting its guidance because of that persistent weakness in the Chinese market, where it's facing so much competition from local manufacturers. The CEO is, of course, under so much pressure at the moment with this restructuring plan and trying to streamline the business. And we have seen Volkswagen shares underperform that broader auto market, which is really saying something given just how much weakness there's been in that broader car making industry already. We've got quite a few names in that German car making industry reporting next week, including BMW, Mercedes and Porsche. And so that should potentially give us a clearer and more complete picture of exactly what is going on there and how much that Chinese weakness is really weighing on those companies. And finally, we are going over to Allianz for some M&A. Allianz has bought HSBC Singapore insurance business for $2.1 billion. For HSBC, of course, that's part of that broader streamlining that the CEO has been doing. And then for Allianz, this will give it access to a market that has been and previously failed to enter. Of course, Singapore is one of the most attractive insurance markets in Asia, and it's also that huge, a very important financial hub. And so we could see this lifting the shares this morning for Allianz on the back of this M&A.
Chloe, thank you. Chloe Melly with a rundown of those stocks in focus. I'll add to that, we mentioned the retail sales number out of the UK earlier. Yep. Anything to do with retail in the UK? I mean, could it get a lift, or is this, again, another piece of backward-looking data? Because it's telling a story of optimism. Consumers improving their sentiment after the war in the Middle East had dented sentiment, as if this was a backward-looking dynamic, whereas now we're seeing a flare-up once again and a very unpredictable future for that conflict. I
always think that UK consumer data is basically just a yesterday's weather report, basically. It's an old hat weather report. Was the weather good or bad? Seems to be the biggest dictating factor when it comes to UK shopping habits.
And in this case, it was so hot for such a long period that it was very influential.
Hasn't stopped yet.
No, it has not stopped yet. But that's anyway one sector that we might get some movement in. We will watch that. The futures picture out of the States is sort of flat to negative, isn't it? With NASDAQ futures, interestingly, taking another leg down.
So what you're not getting is a bounce, which I think is really quite significant. Do you want to buy back into the tech story ahead of what is a massive week next week in terms of the earnings story as well?
Not after what Adam Linton just said about next week and SK Hynix and Samsung and all the volatility in those markets. Single stock ETFs bringing a lot of opportunity for some.
It's a very nice way of putting it. I just think the market's going to be cautious going into the weekend. You've also got the risk of a weekend, which traditionally has thrown up big geopolitical problems for the market to deal with. And this weekend looks like it could be just another one of those weekends. So do you want to carry risk into the weekend, I think is a key question. We're about to find out, certainly from a European perspective. 5 minutes to go until the opening trade. We'll bring you all the details. Keep an eye on SAP. Keep an eye on Volkswagen this morning. There's a lot of single stock stories out there that we're going to be watching. That's the futures picture. We'll deal with the details in a moment. This is Bloomberg. Friday morning, good morning. A couple of minutes to go until we start equity trading here in Europe. The good news is that this is where we went out on the US session yesterday, near the lows. We rallied a little bit after that over in the US, but generally actually it was a fairly downbeat session, quite a downbeat session, particularly for the tech space. So that's the kind of the narrative out of the United States. Overnight, the Asia session's been quite negative as well. There are a few single stock stories out there that actually could have an impact into Europe, which could be positive. Intel could be one of them, into ASML and into what is happening in the chip space. But broadly, it's a fairly mixed picture. Euro Stoxx 50 futures, therefore, are going nowhere in a hurry. We're up by 0.1% of 1%. The FTSE's lagging a little bit. We're down by 0.3% of 1%. There could be an oil factor in there. There could be a couple of other things. Oil's back below 100, but nevertheless, FTSE's down just a touch, with a little bit of an outperformer. DAX is down by 0.2% of 1%, and that's taking into account what is happening with Volkswagen. But SAP, which is a big weight kind of in that index, which obviously doesn't have much weighting, but SAP is going to will have a meaningful impact, I think, in terms of the narrative that we're going to be seeing there. So flat open after a turbulent 24 hours, Anna, is I think what we're seeing. What are the single stocks looking like?
Yeah, let's dive into a few of the ones you've mentioned already. SAP, VW, both of those over in Germany are going to be in focus. I'll start with VW, cutting its revenue expectations for the year, now seeing revenue declining as much as 3% this year. So that's one area of focus, and that could put some downward weight on the German market. To the upside, though, in the German market, as you indicate, Guy, ADRs were higher in the States after the numbers came out last night. We are expecting to see SAP bounce. Cloud revenue beating estimates. That's their upside story over at SAP. We'll also keep an eye on those UK retailers on the back of some better data out around UK retail sales, for the moment at least, Guy.
OK, let's step in. Let's figure out what is happening. Let's get into this market open, this Friday session, and show you what the numbers actually look like. I think at an index level, maybe not much in terms of the news flow story here. You're going to get a FTSE that is a little bit negative, but not by much. You're going to get a DAX, which maybe is SAP influence more than Volkswagen influence. We'll have to wait for the Germans to bring that market open to us. Now, elsewhere, I think you're going to see a fairly flat story developing. There's not an obvious kind of new narrative that I think European equity markets have got to price in after yesterday's session, which saw a lot of turbulence. The bond market is getting really interesting. We'll get the gilt open in just a moment, so we'll bring you that as well. But the IBEX is absolutely flat. The CAC's not really doing much. The FTSE, as expected, is down by 0.75 of 1%. We'll wait for the German market to open and see what happens with some of those big heavyweights in that market, Anna, in just a couple of minutes' time.
Yes, absolutely. So we don't have an opening price on the DAX, but we do have some companies over in Germany that are open. We'll get to that in a moment. Looking at the sector picture then, travel and leisure is up by 0.6%. So this is fairly mechanical these days, isn't it? The oil price drops a bit from that lofty level above $100 a barrel. We're at a 98 handle right now. And so we see a little bit of upside for some of those airlines that have been beaten up by a higher oil price. So Ryanair is moving higher, Lufthansa moving higher, and the like. Insurance also okay this morning. That is another sector that moves a little higher, not by a huge amount, but there is some resilience in there, along with real estate. We've seen M&A in that sector this week, which has sort of been offsetting perhaps some of the concerns around higher interest rates, because you would have thought that maybe the higher interest rate story has been weighing on the real estate sector. To the downside then, on the sectoral picture, we've got telecoms, actually the worst performing sector this morning, and that is to do with Nokia. So we had numbers out of Nokia yesterday, so we'll dig into that one a little bit, but that's been seen as something related to the AI story of late. Energy stocks also on the back foot. Again, that's fairly mechanical given the drop in oil prices that we're seeing this morning. We're down by 1.8% on Brent, and so we see some weakness coming through in some of those energy names. But the technology sector is really interesting, Guy, because it's not in itself moving very far as a whole, if you like.
Yeah.
But it is, we have SAP to the upside. That is a substantial area of movement to the upside. And as you were mentioning, I was wondering, Bloomberg Intelligence was talking about how ASML might open at the start of trade on the back of the Intel numbers. Yeah. But that is an area of negativity, but only down by 0.7%. You know, it's a big weight.
The biggest points drop, though,
yeah,
in terms of Europe. That's adding the biggest downside on Europe at the moment. SAP is adding the biggest upside. So that points us in a positive story towards what is happening in Germany this morning. So SAP is having a good morning. It's actually up by nearly 4.25% now. But ASML is down by 0.8%. Oil stocks are lower. Nokia's down. It's quite a big kind of mix in terms of the stock stories that we're watching. I haven't seen Volkswagen, but I think it's coming up now in terms of opening up as well. We'll get to that stock in just a moment. But we are seeing some fairly big moves.
Yeah, Volkswagen down by 2.5%.
That's better than we thought it could be. So when I first looked at the numbers this morning, when they started coming through after the numbers dropped, there was talk of kind of 3.5%, 4% on the downside. So that looks like it could be worse in terms of what we're seeing in Wolfsburg this morning. Let's just see if I can get kind of how it's trading on a tick by tick basis.
Because some of the line that stood out, and it was the red headline earlier on this morning, 6:30 UK time, was around their full year revenue guidance, and it does look quite bleak, doesn't it? When you take it down from you previously were at 0 to 3% growth on full year revenue guidance, and you take it down to a range of -3 to 0. That's quite, if you take the extremes of that, that's quite a hefty downgrade. So maybe down 1.9% in that context is, as you say, not that bad.
Yeah, I think it probably is. It's going to be interesting to see what they do there. What do they need to do now for the rest of the year to try and even stay within that range? I think is going to be an interesting point.
And how much comes down to China? Because that does seem to be the area of weakness coming out in their report. Local manufacturers taking up so much of the demand story there. How much are the German car manufacturers struggling up against those domestic Chinese manufacturers right now? We talk about that a lot in the European context, about how much they compete here in Europe. We don't talk about it so much in China, but that is clearly an area of big competition for these German car manufacturers.
At what point do the Germans just go, we've had enough? We're going to protect this market now, and you are not coming in. Are they willing to sacrifice access to the Chinese market to maintain kind of some degree of protection in the European market as we can increasingly kind of look for localized markets? I think it's going to be a really interesting question.
And just another of the challenges that this company faces after software delays, cost issues, plenty of other challenges that the company has.
So Oliver Crook has been speaking to the Volkswagen CEO. He started by asking you a question about the fact they've cut the full year revenue target, but not the margin target. So how are they going to maintain that margin target? Let's find out.
In the second quarter, the trend from the first quarter continued. Yeah, we make progress on various fields. We brought new cars to the customer, specifically an exciting new electric urban car family. We make also progress on cost and productivity. And then this is also reflected in our cash flow. But you're right, the situation in the industry is weighing on our margin. And in the long term, 3.8% or 4% after adjustment is clearly not enough. If you talk about the year 2026, we kept our guidance outlook because we have some tailwind in the second quarter, specifically product momentum at Audi. Audi expects some very exciting new models in the second half of the year, and we also expect some tailwind on the continuous cost work we implemented 2 years ago. We started 2 years ago, and based on these factors, we keep our outlook.
Yeah, and so we've talked about cost for a very long time, Arno, over the last couple of years. And here in your earnings statement, in the quote that they have of yours, the currently planned initiatives, you say, are not sufficient. One of the big initiatives that there is a lot of discussion about at Volkswagen are the question of job cuts, are the question of potentially factory closures. Will you be able to reach the targets on costs? Will you be able to do what's necessary on costs without cutting jobs, without closing factories?
Well, let me elaborate a little bit on the situation where we are. There are a lot of figures out there. Look, we decided on a first restructuring package, I would say, 2024, late 2024, which incurs about a job reduction of 50,000 in Germany, which includes like taking out capacity of about 1 million and a contribution on the wage side. But since then, the situation has completely changed. Tariffs were introduced, which burdens us by 4 to 5 billion. We see much more intense competition in China, and Chinese competitors are exporting not only cars, but also competitive pressure to Europe. In this situation, we need to step up our efforts and do more fundamental restructuring, and this is what we are talking about in the transformation program. We have some elements on the cost side and on the customer side, and this package should enable us to move into the future with strengths and with confidence.
But I want to get a little bit more into that question of job cuts. I know that there are currently very sensitive and very complicated conversations happening with the unions, but are we reaching a point now where there's a more serious conversation that Volkswagen needs to have? One that sounds something like the future of this company, the existence of the company, is dependent on being able to get those cuts through. Is that the message to the unions?
Look, we have great products, but the costs are too high, as I just mentioned. And we have various elements of these costs. First and foremost, we still have an overhead cost gap to competition in the magnitude of about 30%. And closing this overhead cost until 2030, closing this overhead cost gap until 2030 would mean lowering the overhead cost by 10 to 11 billion. This is one element. And another element is productivity and competitiveness of our plants. We have to increase efficiency in the plants, but we still have overcapacity, and it's very hard to face competition with underutilized plants. So this is the second element of the program. There's a broad understanding in the company that we have to address these topics in order to move successfully into the future.
CFO of Volkswagen, Ola Antlitz, speaking there to our Chief Europe correspondent, Oliver Crook, who joins us now. Ollie, you kind of posed the question, how existential is the threat at the moment? The Chinese car market is brutal and cost competition is rigorous. And he's talking about a 30% overhead gap that exists at the moment. This is a company that has to make some radical changes. How existential is the crisis?
I mean, I think we're getting to a point where you can't really talk around it anymore. And I think that is increasingly the feeling over at Volkswagen. I mean, I remember talking to them, I don't remember what it was, maybe a year, maybe 2 years ago, when they had their first sort of cost drive. They talked about the cost cuts that they had to do. And I asked them then, I'm like, listen, does this go far enough? Because it does not feel like it does. The problem is in Germany that there's so much power within the unions. There is a stake of the company that is also held by the state of Lower Saxony. So they have a huge influence on the board. Obviously, the government does not have any incentive of allowing sort of jobs to be cut. So this is just one of the many ways in which Volkswagen's hands are really fundamentally tied. But Guy, if you just do a quick analysis of the three main regions for Volkswagen, there is a very negative story to tell in basically every single one. On the United States, there's obviously the tariff issue that adds all these kinds of costs. They need to rethink their whole strategy. That has been the big story for the year and a half. In Europe, it's all about the Chinese competition within the European market. And you saw it in the car sales figures represented that we had yesterday. And we had a story out in the month of June that effectively of the plug-in hybrids that were sold in Europe in June, a third of them were dominated by the Chinese automakers. And that's bearing in mind that these Chinese automakers are still paying tariffs to bring their car into the European tariff zone. In the next few months, in the next few years, there will no longer be any tariffs on these Chinese vehicles because they will produce them locally. And that, of course, will bring the price down even more radically. Then you look at the Chinese markets. I mean, the deliveries in the second quarter in China for Volkswagen down 37%. If you lose a third of your market, consistently, there's a big question about what the future is going to look there. Obviously, the competition is very intense in the Chinese market. They're buying very, very largely EVs, but overall, it's a very, very tough market in every single one of the main markets for Volkswagen.
And so you wonder then, closer to home, Ollie, when it is going to be the case that Europe, that Germany decides that it needs to do more to protect this industry from Chinese competition. What's the broader narrative around that? Because the German perspective had actually been quite nuanced, because they operate in China and they don't want to kind of shoot themselves in the foot in terms of their ability to sell into the Chinese market.
Yeah, absolutely. And I mean, this is a theme that you guys have been talking about a lot over the last couple of weeks, and I think it's dead on. I mean, if you lose a third of your market share, or say a third of your sales in China year after year after year, China becomes much less important to you as a market for these Chinese automakers. And of course, they are one of the great lobbyists against trade barriers, against keeping open markets, because historically, basically, Volkswagen had something close to a monopoly in China for ICEs back in the 1970s when it went in there. The dynamic has completely changed. Of course, the Chinese have basically adopted the German model. And in fact, until 2010, Germany was the largest exporting nation on the planet. It is now, of course, China. And so you're getting to a point now where some of the leverage that these companies had on the government and trying to put pressure on the government, on Friedrich Merz, not to basically get on board with some of the initiatives you get from, for example, Emmanuel Macron, who is much more conscious of trying to defend the European market. The reasons to not get on board begin to diminish. They begin to diminish. And we have reporting over the last couple of months that for Friedrich Merz, the Chancellor of Germany, this is now a more active debate. Historically, the Germans have been very, very resistant to this, but we understand that he is now potentially turning the corner, and this is a very active conversation here in Brussels and is going to be for the next couple of months and years.
Ollie, great stuff. Great interview. Thank you very much indeed for bringing it to us. Our Chief Europe correspondent, Oliver Cook. Let's take a quick look at what is happening with the Core 6 and show you some of the numbers that we are seeing this morning. Quite a mixed picture, quite an interesting picture, actually, I think, developing this morning. Tech is definitely under pressure, which I think is something that it was difficult to call first thing this morning, because there's a kind of single stock narrative, which I think is kind of playing out here. And tech is not uniform either. So ASML is down, but SAP is up, as Chloe's about to tell us.
Yes, indeed. Good morning, Guy. We are seeing SAP up quite strongly this morning, almost 5% after cloud revenue came in ahead of expectations. That is because the migration of customers onto the cloud is accelerating. And so this is quite a positive update from SAP, and that reassured investors after just so much weakness in that stock recently. So we're up quite strongly there. We are down, however, for Volkswagen, perhaps not as much as we had expected. We are in the red for the car maker this morning after it cuts its guidance because of this weakness in the Chinese market. And so we are down about 2%, perhaps because of all of the negative sentiment over the last few weeks, all of the bad news coming from Volkswagen. Some of that weakness was already priced in, and that explains why the shares are down, maybe not as strongly as we might have expected. Moving on to Wise, and there the shares are down very strongly this morning for the fintech. We're down almost 9% after the US banking regulator rejected its application to be a national trust bank. So that's a huge setback for that company as it tries to expand into the US market. We are also in the red for Carrefour. The French supermarket has missed analyst expectations on earnings and revenue. We're down about 5% this morning on the back of this, with analysts saying that the company really needs to work on improving profitability in the French market. The other markets are actually doing pretty well, but the French market is very weak, so it really needs to work on that. And finally, Arcadis, the Dutch engineering firm, is up quite strongly this morning, about 6%, after receiving a second unsolicited offer from its Canadian peer WSP, and now the company is reviewing this latest proposal, and we are up quite strongly on the back of this M&A offer.
Chloe, thank you very much indeed. Chloe Melly with all the single stocks.
I was too excited about French PMIs. I nearly jumped in, which I wouldn't do. But we've got the composite PMI number looking at higher than had been expected. So 49.6 is where it's come in. So it's still below 50, still in contraction territory. But it is above that estimate. And it's the services side that seems to have come in better than expected. That doesn't seem to have moved the euro, because the euro actually spiked ahead of those numbers, which is interesting.
Always interesting. What is interesting also about this is that the service number is still negative, i.e. it's a diffusion index.
Below 50, yeah.
So it's still below 50, so you're still seeing contraction. And what you've got is a manufacturing number that has moved closer to 50 from 51. So on aggregate, yes, I would say maybe the number's a little better than anticipated, and the private number was sort of 47, but we're still contracting. We're just contracting it at a lower rate, a slower rate. Anyway, we'll park that and come back to it maybe in a few minutes' time. Let's talk about one of the other single stocks that we're watching this morning. Vontobel, the Swiss investment management firm Vontobel, reporting first half earnings. Let's go to Zurich. Let's speak to the company's co-CEO, Christel Rendu, who joins us in just a moment. We'll get to that in just a second. We'll do that conversation and talk a little bit about what is happening in terms of demand. That's coming up. This is Bloomberg. 20 past the hour, welcome back. Vontobel stock is up by, let's call it circa 1% this morning. This is the Swiss investment management firm reported a record profit for the first half. Clients basically are adding new money. They've got a cost-saving plan. That's beginning to reduce the cost base. These two things basically working hand in hand to produce the numbers that we're talking about. Vontobel's co-CEO is Christel Rendu, and she joins us now. Good morning. Is the plan working, I guess, is the simple question.
The plan is definitely working. You see it with a record set of numbers in terms of profitability, assets under management, but most importantly, what you're seeing from clients. So clients choosing us across segments, geographies, for our leading capabilities. And that is really not only the plan, which is working, and what's working is this operational leverage that you mentioned. So we're disciplined on the cost, and that gives us the opportunity to invest into growth, into our ambitions for our clients. But the client choice, this is what's fundamental and structural, and is around our differentiated positioning. And that will only compound over time, given the type of markets that we're seeing. That's a strong conviction.
Good morning to you, Christel. Can I ask you about the sort of dominant trend within Swiss wealth management right now? Some people are talking about getting a boost from maybe some in the Middle East, moving some of their money into Switzerland. Others are talking about competition being tough from the likes of Hong Kong for offshore wealth management. What's the dominant theme for you driving the highs and lows for Swiss wealth management?
So I will speak very specifically for us. Actually, the driving theme is really that differentiated positioning that I've been mentioning, and I'll link back to your question in a second. But, you know, that differentiated positioning is that clients do not come to us because we're aggressive in lending. That is not who we are. In fact, we pledge to be exactly the opposite. They come to us because what we bring is the asset management skills, discipline, traceability, repeatability, to all our clients, including private clients, and we bring the ability to customize around an outcome that you traditionally see in wealth into the institutional clients. And that is what will resonate going forward. Now, what is important for Switzerland? It's this stability that I mentioned. It is also part of us. That is still a trend that is very strong for Switzerland and continuing to play favorably for Swiss wealth and asset managers alike.
Given you've got this plan and that it's working and it sounds like it's giving you confidence, are you starting to kind of raise your eyes a little bit and think about what you could do next, how you could sort of step change the growth that you're seeing? That takes me to the M&A story. Are you starting to think about that? Is that a way that you could utilize maybe to grow faster?
Yes, by all means. I mean, this is something in a sense that we always have in our minds, and that was the whole idea about the program, the efficiency program that we decided was to have that strategic flexibility to invest, whether it's organically or inorganically. And indeed, this is it's something quite differentiated when you think about the landscape in Switzerland and how we have grown over time. We've grown both organically and inorganically. Many choose to do one or the other. And inorganically, what we do is either scale in our private client focus markets or additional skills. So in Ankala, for instance, which is still in the pipe for us. But we have our eyes very much open for this type of inorganic growth, yes.
Okay, so eyes open for M&A. Can I ask about AI? The changes anticipated within the wealth management industry, they could be large in scale. Christel, what are you expecting around the AI theme?
So I personally, I'm super excited because I think AI has these two components, right? The one aspect is automating tasks, which is not necessarily the most exciting. It's a nice feature, but the way we think about it is the augmenting skills part, because this is the part that really accelerates you. Is how do you build on your own edge? A little bit like on sport, you know, you should not only work on your weakness, you should actually predominantly work on your strength. And as an active manager, active advisor, you can definitely augment your skills with AI. And that is totally the frame of mind that we have. And it's going to up the ceiling of the industry for sure.
Christel, you said earlier in this conversation, the first answer, you talked about these kinds of markets. What are these kinds of markets? What are your clients doing right now? How do they feel about private markets? We seem to have a story every quarter about massive redemptions. Are they steering clear of private markets? What do they think about the AI trade? Are they worried about bubbles? Talk to me about the narrative that you're hearing from your clients right now.
Yeah, so these kinds of markets, what I meant was that it's actually quite schizophrenic, or it does feel at times, right? Because we're cruising along, and that is because the economy is strong, AI is a powerful theme, but we've got this massive turbulent phases, these air pockets. And that is, I think, what's here to say. So that's these kind of markets. That's what I meant. And what we are talking about with the clients is about building resilience in the portfolio. The clients, both actually institutional and private clients, do not want to miss out on the up market. So just going to the side is not, that's easy to discuss, but that's not the way you make money and you grow capital. But at the same time, no one wants to be caught sort of wrong-footed still in a theme that could look extended, or where for sure, in hindsight, people would say, how could you?
Yep.
So resilience can be, how do you diversify away that theme?
Okay, how could you? I'll remember that one. Thank you very much indeed. Christel, we really appreciate your time. Vontobel's CEO Christel Rendu. What have we got coming up?
Coming up, we'll focus in on the oil price again, hovering above $100 a barrel, where it has been. It's a 98.65 right now. That's renewing inflation fears. We will get an equities perspective on that, though. We will speak to Sebastian Redler, Bank of America. This is Bloomberg. This is the opening trade, 30 minutes into Friday's session, and it's a positive one actually now. Took a while to get there, but the further we see the oil price drop away from that $100 a barrel mark, the more room there is perhaps for a little bit of strength coming through in European equities, and that seems to be what we're seeing now. So the DAX is getting the best of those gains, up by 0.6%. The CAC 40 lags a little behind, but still, generally we are seeing these markets move a little bit higher, perhaps with a bit of relief on the back of that slightly lower oil price. Let's talk about what we're seeing in the indicators around growth or otherwise in the European economy. We've got the German July composite PMI joining the French PMI this morning. It's rising, so that's the similarity. It's rising to 51.2 against a forecast of 49.7. So a guide that's back into expansion territory by a little bit, not by a huge amount, but by a little bit, and better than anticipated. The euro had been moving higher in the run-up to that French PMI data, and now seems to have taken just another leg higher on the back of that French PMI data into this German print. So we'll keep that in mind as we look at some of the more detail around this session.
Can you just ignore the data, though, this PMI data? Because what we're seeing effectively here is a reaction to a lower oil price. Germany's clearly highly dependent on the oil price, particularly dependent, even more so you could argue, on the gas price, which came down pretty sharply as well. All of that's reversed since we took this data. So I don't know, pay your money, take your choice on that one. 2-1 on the upside, certainly is the narrative at the moment. Oil price is rolling over. We're just back sub 100. Volume's ticking up a little bit, but definitely we're on the front foot when it comes to the stock story here in Europe and gaining a little bit of traction. Leaders look like this. SAP on the back of its numbers, which have outperformed, are doing very nicely. Arcadis is up as well. I think that's an M&A story. I think the Renshaw's a numbers story. Both of those two stocks are reacting as well. I hope I've got that the right way around. Let's talk a little bit about what we're seeing on the downside. Here you've certainly got some some weakness coming out of Germany as well. You've got, actually, I don't have Volkswagen on there. Wise is down as well. That's a banking license story. Carrefour is down 6%. And Neste in the oil space is down by 8%. So some fairly significant losers. But we are basically 2-1 on the upside in terms of the narrative, and that is pushing European stocks higher this morning, Anna.
Let's get an update on some of the other news flow this morning then, Guy. Let's start with the tariff story. The US will collect duties of at least 10% on imports from most major trading partners as President Trump moves to reconstruct his global tariff regime. The new levies follow an investigation into the alleged failure of around 60 economies to prevent forced labor in their supply chains, to the detriment, according to the US, of American workers. Trading partners have criticized the tariffs as baseless and unjustified. The Spanish government has declared a national state of emergency due to wildfires on the outskirts of the capital, Madrid. Madrid's regional president has requested the central government take control of fire extinguishing tasks after blazes forced the evacuation of thousands of people across the region. And Volkswagen shares are lower this morning after the German automaker cut its sales outlook. Europe's largest car maker now sees revenue declining as much as 3% this year. The results underscore the scale of the challenge for the CEO, Oliver Blume, who is trying to make Volkswagen faster and leaner after years of software delays, bloated costs and declining profitability. Guy.
OK, let's just come back to the market story this morning. Equity futures are certainly picking up stateside. That is the narrative we're getting from the other side of the Atlantic. One of the reasons for that is that oil prices are coming down relatively sharply this morning. We're definitely below 100, and that is the narrative that I think is turning things around a little bit. Quick look at the bond market as well, which I think is a kind of an interesting trade around all of this. You've certainly seen a big turnaround in the US 10-year. Had a 4.7 handle, now has a 4.6 handle, and you're certainly getting a decent bid coming back into the European bond market as well this morning, so yields are lower. That's the kind of the background of narrative that we're looking at. Does it all hinge around the oil price? What else is a fact? What other factors do we need to fold in? How bullish should we be about this equity picture right now? Let's try and answer some of those questions. Sebastian Redler is the head of European Equity Strategy, Bank of America Global Research, joins us around the table this morning. Bullish or bearish?
I'm bearish.
Shocker.
Talk
to me about the narrative. I got some PMI data out of Germany that looks better. I've got an ECB that's only going to raise one more time. The oil price is up, but it's not streaking kind of above 100 this morning. Why is that all negative?
So first of all, fully agreed. The data is looking better than expected. Once more, like last year, you had a big shock with the Iran war. Global macro surprises hardly turned negative, and they're now back at a 3-year high. But we have to see it. What is the picture in terms of the risks and the opportunity, and what is priced? And if I say to you what is priced, margin expectations at an all-time high. You've got expected 5-year forward earnings growth at an all-time high. You've got market cap to GDP globally at an all-time high, and you've got risk premium at a 20-year low. What the market is pricing is a scenario where everything goes right and there are no risks. And then we look at what happens in reality. There are a lot of risks. And specifically, you have a once-in-a-generation CapEx boom that has basically generated this kind of picture, but there are a lot of cracks in that CapEx boom. And we know historically how that story ends. And we're seeing problems coming up in terms of customers' willingness to pay, borrowing costs for the hyperscalers and so on. There are risks that are not priced. And then you look at the Middle East, clearly you've got challenges there, especially with the crack spreads exploding as they have. So I'd say the market is pricing no risks, but there are risks. You're not being compensated for those risks. That is not a bullish picture.
That's not a bullish picture. No, it isn't. I'm stunned. We were talking to Vontobel earlier on, and they were saying that turbulence is here to stay. And so these are some of the risks, I suppose, that you think the market is underpricing. Sebastian, how do you protect yourself from an expectation that turbulence is here to stay? Because on the one hand, that can create opportunities for alpha, can't it? So what's the mindset when it comes to being in a world of higher turbulence?
Yeah, so the interesting thing is that you have what I would call a K-shaped, very bifurcated equity market where everything that offers safety and defensiveness has been thrown to the dogs because it has been so far from the winning theme, which is the AI theme. Everything that's close to the AI theme, at least until the recent momentum unwind, was flying high and priced for something extremely bullish. So I would say the best way to protect is to pick up these very beaten up things like quality stocks, things like staples and pharma. They basically are trading on extremely undemanding valuations. If anything goes wrong in the world, they will look a lot more attractive. And you're picking them up at very cheap valuations.
So that sounds like you should be quite bullish on Europe then.
No, because Europe is still a very cyclical market. It's a value market. And on a relative basis, maybe if tech goes wrong, maybe if the AI story goes wrong, Europe will do well. But in absolute terms, it has been pulled up as well and is trading on very tight risk premia that really require everything to go right from here.
Quality stocks are a relative trade or an absolute trade?
It's a relative trade.
Okay.
So I think generally, if you're looking for hiding places, you're thinking about things that do better in a more challenged market.
How big, if you do get a drawdown, how big could it be?
So in our base case, we see around 7-8% downside, partly because we are very respectful of the point that you made. The macro data is still doing well. But then we have to see if at some point the AI capex wave crests, then growth will be weaker, earnings will be weaker. And there's a very interesting point from the Bank for International Settlements. They say a lot of this AI investment is now debt financed. There are a lot of financial interconnections between these players. And what they say, once the music stops and once the spending disappoints, there's a lot of debt that will be hard to be financed. And then, of course, if you get financial stress, as they expect, once that starts to roll over, then, of course, you're not talking about 5-6% downside. You're talking about something more.
Okay. So you could argue, do you argue, that then a cresting of the AI capex wave will become systemic on the other side?
History strongly suggests, and they've got a very nice chart. Normally, I would never recommend to you reading the annual reports from the Bank for International Settlements. Right. I think this is an exception.
We've got a weekend coming up, Sebastian. So, you know.
I'm sure you're going to do more fun things on the weekend. But maybe in a lazy moment, they've got a great chart that compares the current AI capex surge to the big boom-bust cycles of the past. They go all the way back to the canal mania of the 18th century, which I'm sure you'll remember. And of course, once that rolls over,
that was harsh.
Yeah, I know.
No.
Not personally. I mean,
what I wanted to
I'm aging really well.
What I want to say, Anna's exceptional knowledge of financial history, of course, that's what I was referring to.
And the tulips. I remember all of it.
Exactly. And the way that has typically played out, of course, once that rolls over, especially because at that point, typically margins are very inflated, valuations are very inflated, growth is very inflated. Of course, the deflationary impact when it rolls over historically has been brutal. And so therefore, as one client said to me, we have to survive twice here, on the way up and then again on the way down. So for now, we only have mild downside. We just think expectations are too high. But of course, we are watching to see whether history is a guide. And if it is, then once the regime switches, it potentially will be quite a ride.
But at the moment, we're on the way up. We're not on the way down. And I don't know how much further the way up has to go. So the danger is rotating into those quality stocks early, isn't it?
Absolutely. But there's danger in both directions.
Yeah.
And what I'm saying is, in one case, you already have all the good news priced in. And look at how quickly the Kospi, for instance, which is the poster child of this whole thing, is down 25%, with very little happening by way of fundamentals. The more expectations are stretched on the upside, the more risky it becomes. And I'm saying is, sure, you could be early in the quality stocks, but nothing is priced in. So therefore, that scope for disappointment is a lot less pronounced than it is in the stretched AI trades.
Just briefly, Sebastian, are you nervous about all of the tech earnings next week, including SK Hynix and Samsung and everything we might learn from that?
I am nervous. And it's clearly a very high-stakes game. But what we're seeing, for instance, in the Google and the Alphabet results, you can have very good results. But if expectations are so stretched, you might still get pummeled.
Thank you very much. Thanks for joining us. Sebastian Redler, Bank of America Global Research European Equity Strategy Head. Coming up on the programme, sweeping new US tariffs come into effect as President Trump rebuilds his tariff wall. But what impact does it actually have? We'll have the details next. This is Bloomberg.
Welcome back. 44 minutes into the equity market session, and the big thing that you need to know right now is that the oil price is lower. Brent is back below $100 a barrel. We're at 98.84. We're down by circa 2% right now, and that is rippling across equity markets globally and equity market futures globally. European stocks are on the front foot as a result of that. I think they've just been given an extra boost by that. Plus, also, the German PMI data actually looked fairly favourable this morning.
This in the context of more tariff headlines. We're back to getting tariff headlines from the Trump administration. The US will collect duties of between 10 and 12.5% on imports from most of its major trading partners. That's the top line, but let's get into some detail. It is the biggest move yet to reconstruct President Trump's tariff wall that was struck down by the Supreme Court. Joining us now with those details, Brendan Murray, who leads our global trade coverage. And Brendan, of course, you see these headlines and then you immediately want to get a sense of how much they really matter, because we have had 10% tariffs and now we're going to continue to have these 10% tariffs in the context of these other tariff deals which seem to override these tariffs, and then lots of sectors that are excluded. So whose life is changed by these tariffs today?
Well, some of the countries that woke up today saw their tariff threat go down from the 12% bucket to the 10% bucket. We saw that with India, with Cambodia. And so some countries were relatively surprised on the upside to say, OK, it could have been worse for us. But then you have, this is about $1.1 trillion worth of imports into the U.S. that are getting hit with these rates, the 10 and the 12.5%. So that's about a third of all American imports annually. And so it's not a gigantic change in the economic picture, but each country is going to look at this and say, what can we do to improve our forced labor situation, so to appease the Americans? And of course, you have companies that are going to have to pay these tariffs, calling their lawyers this morning and saying, is there anything we can do to chip away at this from a legal perspective?
Forced labor. Is that really the reason behind all of this, or is it?
Well, I mean, a lot of what's driving the Trump administration right now is the revenue that they need to generate to close, a huge.
So this isn't driven by false concerns. Does the UK have a big problem? Does Europe have a big problem with this?
Well, according to the USTR, all of these countries do. This is the 98-page report that they released 6 weeks ago. A lot of people would say this is a pretext to put tariffs on that the president, lost that authority back in February, and so, but countries. For the most part, the reactions today range from mildly upset to, kind of taking their medicine and trying to move on.
Yeah, and to your point, some pushback from some of those countries that are affected, certainly in Asia. There did seem to, further down our stories on this, Brendan, there did seem to be a little more nervousness around some of the other 301 investigations that are going on, something called investigations into excess capacity, and some in the trade industry suggesting that actually this could be an area where we see another step change in the tariff regime. Is that something we need to look ahead to?
Absolutely. This is a case that the Jameson Greer, the U.S. Trade Representative, has said is coming. It's taking longer. We understand that it could be maybe August or September before those results come back. But that would be another tariff, whether it be 10% or 25%, that the administration could stack on a smaller group of countries. But still, the European Union is in there, China is in there, and so this is not the end of the new tariff regime. It's in a lot of ways it's the start of a new beginning of it.
Brendan, great to catch up. Thanks for updating us. More tariff news. Brendan Murray updating us on that. He leads our global trade coverage. Let's talk about some of the single stock stories. Let's talk about tech, actually. SAP shares climbing after the software company reported second quarter cloud revenue that grew faster than analysts expected. Now, earlier in the show, we had the great opportunity to catch up with the company's CEO, Christian Klein. He was talking about actually some really interesting issues around AI and how his company is using frontier models, open source models, and how they're trying to control token costs in terms of integrating AI into their story and how they're managing costs around that.
In the R&D costs, you see, a higher token consumption as we are using AI to code additional features, but especially now additional agents. But vice versa, you also see a huge productivity increase of 30%. Obviously, we are also managing tokens as part of our cost budget. Yeah, you have a headcount budget, you have third-party budget, and you have tokens. So our managers in R&D, in the go-to-market space, they have one budget, and they have to manage that also according to the productivity assumptions we reflected in the budget.
Okay, let's talk about that. Let's talk about all the other tech news we've had out overnight and this morning. Bloomberg Intelligence senior analyst Matt Bloxham joining us now. The market likes SAP this morning. Why does the market like SAP this morning?
I think because you're seeing perhaps a slightly better than expected shift from the old kind of on-premise based software licenses sold to cloud.
Okay.
There's a hard deadline coming up for customers. If they don't switch, they're going to face higher maintenance fees. And I think perhaps the amount of revenue transitions a little bit better than expected. And I think you have to put into context, SAP share price has been on a one-way street for a long time. So the market is not kind of really particularly optimistic about this company. So you get a little bit of, slightly better than expected good news, and then the shares react a bit. But, the numbers were only fractionally better than expected. There's no change to the full year guidance, but the full year guidance for revenue and profit is a little bit above where the market is. So maybe there's going to be a small upward revision to estimates.
We'll watch this, and we'll watch how they deal with these sort of SaaSpocalypse threats. In the wider tech landscape, we also had these numbers out of Intel.
Yeah.
I know some in BI were joining the dots between the Intel numbers and what ASML could make from that. And what is the takeaway from that Intel story?
That Intel is back. I think, and it's been coming back for a little while, really was on its knees. And I think two things going on there. One, as AI shifts from training models to actually deploying them in real-world situations, the demand is going back towards general-purpose computing, CPUs, which is what Intel's always been famous for. So seeing huge demand growth for that, and they're expanding capacity to deliver against that demand. And secondly, although it's still kind of bubbling away in the background, their foundry business, so them building chips for other people, is definitely gaining traction in the background. So the likes of SpaceX, for example, looking to work with Intel to kind of build their terafab capabilities. So whilst that's yet to come through in the numbers significantly, I think there's growing optimism that actually that business is going to grow because people are looking to diversify away from the traditional chip providers.
And that's to make them in the States as well,
exactly.
Which is geopolitically of some significance.
Anna's reading complex reports this weekend.
Absolutely, from the BIS.
From the BIS about AI.
It's on my reading list.
What am I going to be doing in terms of getting ready for tech next week? What are you watching out for?
Well, obviously we've got Meta, Amazon, Microsoft, Apple. I think if we look at Meta, Amazon, Microsoft, I think the big focus is going to be what they say about CapEx, because we had the kind of the prelude from Google raising this year's CapEx numbers. They've already signaled CapEx is going to go up a lot next year. People will be seeing if they follow suit. And are we then stretching the relationship between investment and return?
Yeah, absolutely. And what's the sweet spot for CapEx? The Goldilocks sort of story.
I think we're probably beyond that.
We're beyond that. Okay, well, there we are. That in itself is revealing. Matt, thank you very much. Bloomberg Intelligence Senior Analyst Matt Bloxham with a bit of a look ahead there to what to expect next week from the tech stories. Joining us now for more on tech is Kit Rees, editor of our Markets Today blog. Kit, nice to see you. Let's talk about the tech earnings then, because we're looking ahead to next week, expecting perhaps quite a lot of volatility. We talked to the Markets Live team earlier on. Adam Linton was reminding us of the volatility we get on an average day around SK Hynix and Samsung, and that's even without the earnings stories. So what are we looking ahead to next week?
Well, the tech earnings are going to be super duper key for market sentiment more in general, really. But one thing that I wanted to take heart from was that despite the disappointment around Alphabet's earnings and, the worries over capex and spending, that the markets have actually held up pretty well. The Nasdaq 100 is only down about 1.6% this week. Same also for the S&P 500. And volatility remains relatively contained. So we've got the VIX below 20, and that's considering everything that's going on in the world in terms of geopolitics and oil and all those concerns. So there's going to be a lot of focus on the capex numbers, of course, and spending intentions, and also the wider existential questions of whether these companies are becoming more industrial. Maybe they're becoming more utility-like, given they have such big fixed assets now. So it's going to be really key for market sentiment. But overall, it does seem that markets are holding up relatively well.
Fed next week, Bank of England next. Should we be excited? Of course we're going to be excited. What is going to be exciting that comes out of this? Is the Fed going to raise rates? What's the Bank of England going to tell us?
Yeah, it is very exciting, and I'm always very excited for a Bank of England meeting. But, markets have moved so quickly this week alone, and we've had oil hit $100 a barrel. So, central bankers are going to be paying very close attention to this. So we had the ECB yesterday saying that, hinting at perhaps a September rate hike, and we might even have the Fed also think about moving in the future. So we're going to be looking a lot at the forward guidance, a lot of the rhetoric that comes out from central bankers bankers. But one thing that has struck me is that they're very focused on second-round effects. This is when higher oil prices cause things like wage growth in the economy, and we just haven't seen those signs yet. So it might just be that the central banks are happy to stay on hold for now, see what happens, and whether the conflict in the Middle East, all those tensions get worse.
Yes, I mean, we're joining the dots between what's going on in the Middle East and what that means for central bank policy. You said we're looking for forward guidance, but I wonder what on earth we'll get from the Fed, because they're not such fans of that anymore. What about the oil story and how much you see that cutting through then, Kit, when it comes to the markets next week? The weekend always proves to be a huge unknown, doesn't it? I mean, all this week we've gone higher on oil. We're up 38% in July, but then we're tracked down today by 2%, and we just wait to see what happens, what's delivered over the weekend.
Yeah, I mean, there could be a bit of volatility, especially coming back from the weekend next week. We'll just see what happens in terms of those tensions and also the questions over supply and whether, we've had the Houthis open up another front in the Red Sea, which is obviously a bit worrying. And, I mean, the question now is, oil at $100, can it go higher, and where will it ultimately settle, and how long does that land? And this will inform everything for markets, for investors, for central bankers. But, of course, it's just so unknown, and there's just so much uncertainty that it's really hard to say what's going to happen and how it could all shape out.
Kit, nice to see you. Thank you very much indeed. And we're all excited about the Bank of England. Kit Rees, editor of our Markets Today blog. Thank you very much indeed. We're almost there. The weekend is almost upon us.
Yes, we've already established that I'm busy reading an AI BIS report. What are you watching?
There's going to be a lot of sport this weekend. Not as much sport as there has been recently.
Is this the first weekend we are without the World Cup in a very long time?
So
which has crowded out everything.
It has almost. Like, there's been some tennis, there's been some rugby, there's been all kinds of other things. But yes, I think you're right. The World Cup has pretty much crowded out everything. But we've got the Hungarian Grand Prix coming up this weekend. The Tour de France finished, I think it's Sunday. They get on the Champs-Élysées. There's obviously some quite big hills to climb between now and then. Commonwealth Games in Glasgow. I'm sure Anna's going to Bruno Mars.
Well, one of our producers snuck that last one in, didn't they? We think we might know who it is. The Pulse is up next. Have a good weekend. This is Bloomberg.